What's going on? We're back with the Namra podcast, part 2 with Nick Hayes. And we wanted to do this as make sure that these episodes kind of follow each other right away because of everything that's going on with UST and some of the current events in the news. So welcome back, Nick.
Thank you.
Under some really odd circumstances and kind of shitty circumstances really in the crypto world right now. So first, I just want to kind of start off with having you explain what the past couple weeks have been like, what's been going on for those of you who haven't been keeping up with the news, some of like the biggest crypto news ever, right? I mean, one of the biggest events ever. So I'd like you to kind of explain that, and then maybe we can go over some things that we didn't really touch on enough, like the inherent risks that are involved in crypto and you know, some things that we really want to touch on more this episode. So Can you kind of unpack a little bit about what's going on for those people who haven't been keeping up with this?
Right. Yeah. So just like you said, the first time that we talked, we didn't really talk about a lot of the inherent risks that come with crypto. So definitely want to make sure that for especially the people that are new to crypto, they understand a lot of those risks that do come along with the new technology that is being built.
Yeah. And to be very clear, this is not investment advice at all. This is a podcast to talk, to share information, to talk to cool people, not to give you investment advice whatsoever.
Correct.
So say that again for the people in the back.
Right. So last time we talked about Terra, UST, which is a decentralized stablecoin, and Anchor Protocol, which I described as basically a decentralized bank. It's a lending and borrowing protocol that you can earn high interest yield. Basically, in the last month since this...
And how long were people, like, how long was this going on? Like, it was yielding 19, 20% for over a year, right?
Yeah, over a year. Basically, to kind of recap what Terra is, the founder originally wanted to create a decentralized stablecoin because he believed that decentralized economies need decentralized money backing them, which you know, a lot of people in the industry agree with, and I still think long term will come to fruition because right now basically all of crypto is run on these centralized rails through centralized stablecoins, USDC and USDT, which are backed by, you know, centralized companies. So those have their own inherent risk involved with them. You know, USDC is run by Circle. It's a U.S. Company. If the government says tomorrow that they want to freeze that bank account that all the funds are in, USDC is basically worth nothing until they unfreeze the bank account, and basically all the liquidity would dry up. USDT is run by a foreign company. Their reserves have been, you know, shady at best, whether they are fully backed one-to-one. A lot of their backing and their reserves are, you know, commercial paper. Which,
I'm assuming it's not super transparent. For
exactly, yeah. So that's always kind of been a shadow over the industry that could, you know, be the next black swan event, you know, similar to this UST debacle. So the founder, his name is Do Kwon, wanted to create this decentralized money, but with decentralized stablecoins, because they can't be backed one-to-one with real dollars in a bank account, they inherently have to be algorithmic, kind of run on code and through these incentive mechanisms that are done on-chain. So it was basically fairly stable for the last year and a half. There was some slight depegging events where it went off the dollar, but basically the mechanism worked where it came back to peg every time previously. The real problem with it is that this Anchor Protocol, it was paying out 19.5%, you know, over again the last year and a half. At first, it was actually making a profit, and then as it grew popular, more and more people were depositing funds, but not utilizing it enough to generate enough revenue to become really sustainable.
So people weren't using, like, loaning against it.
Right, exactly. Yep. So
they were just using it for the interest bearing.
Right. So the company, Terraform Labs, they at first started to fund it with their own money, you know, and it was basically a marketing spend where there was just customer acquisition. They funded it with like $70 million, and that was like the yield reserve. And, you know, whatever that deficiency was, they would cover that. And that did a really good job of bringing a ton of people into the ecosystem. A lot of builders came into the ecosystem, and, you know, the price of Terra, or Luna, which is the coin backing it, you know, exploded in growth.
And so to just pause right there. Right. So at this point, we have We have UST, so Luna, Terra Luna, and then we have the Anchor protocol, which is how can you describe like what that is in comparison to it for those people listening at home?
It's basically just an application that's built on top of the protocol. So I know last time we talked about Ethereum, it being a smart contract platform, and then you can build applications and businesses on top. It's basically the same thing.
It's a business that's built on top of that platform.
On top of Terra. So yeah, this bank, you could call it, was paying out this high yield, even though it was technically running a deficit, because the Terra team was just funding it with their own capital to attract users into the ecosystem to start using UST and other ecosystem projects. The problem really occurred, last October. In November, when the market started to like sell off and there was some top signals, people started to sell into cash, and at that time started to sell into UST, which was actually a good thing for the ecosystem because people started to buy UST, and the market cap of it exploded. It went from like $2 billion up to I think 14 or 15 billion at the top. So it just
basically people were trying to put their money there to stay safe. That was a safe place to put their money.
Exactly, and to gain some yield while the market was going down. Yep. But in doing that, it depleted that yield reserve like significantly. So initially, I think last summer it drained that $70 million went away. They then funded it again, and then they funded it again with like another $500 million.
Because people weren't utilizing it. They weren't taking loans out against it to replenish that yield. It wasn't making money.
Correct. And everybody, since the beginning, I said this is, not going to last long term.
It sounds like the U.S. Social Security system, where we just keep putting money into it, or taking out of it.
Everyone knew that it wasn't sustainable. In the forums, people talked about it, all day, arguing about how to make it more sustainable. The problem that ended up occurring is that they implemented these changes to make it more sustainable, probably 4 to 6 months too late. So actually, last month, they implemented this dynamic change to the interest rate where it would drop until it basically reached that parity level to where it was like a break even.
Got it.
So it dropped from 19.5% to 18. It was going to go down to 16.5 and until it reached that parity level. And at that point, it would become sustainable. They would no longer really have to top it up with any new funds. And therefore, they could slowly drop the deposits of UST over time if people weren't happy with the 16% that they could pull out, but people wouldn't pull out all at once if they dropped it from like say 20% to 10, because that could cause that depegging event. So they were trying to do that slowly. So, we probably had, 6 months of runway before we became sustainable, or at least the ecosystem did. The problem is that then when the market started to sell off, people took their UST out of the system and then, sold UST on the open market. And a lot of these large whales, also took their funds out and really started market dumping it on the centralized exchanges and the decentralized exchanges, causing, basically every exchange to go off peg, and people started to freak out. And basically there was a bank run on the system where everyone pulled out at once, and the whole thing just completely collapsed and caused what's called this like death spiral. That's what's happened since the Luna token's gone to zero. They're actually relaunching it today. Don't know what'll really come of that, if there'll be any value in the ecosystem as is without the UST stablecoin. But
now, how is this different than, say, because businesses in the open market can go into death spirals very quickly and very, very similarly, right?
Correct.
Now, how would you say that this is different than one of those events? And how does that outlook going forward? What is that going to be like moving forward? Is anyone going to trust this thing to invest in it again? Because again, I'm assuming they're still going to fund it and offer high interest yield rates.
Well, so they're doing away with the stablecoin. I don't think that they're going to give another attempt at UST, at least not in its current form. There is some talk that maybe they're going to try to have like some fully backed decentralized stablecoin. There is some other ones, like say there's one called DAI and Frax that are almost fully backed. So they might try that in the future, but for now they're just going to relaunch the chain just as a smart contract platform like Ethereum without their native stablecoin.
Yeah.
There's going to be like less value capture because of that. So whether the new Terra chain competes just against the rest of the layer ones, hard to say.
Okay.
There is like a lot of value that was created and a lot of really smart people and good user experiences on these applications that were built. And that is what, attracted me to it initially, was all the innovation that was being done. But I already know that some of the main players and like venture partners that were backing it have basically pulled out, or like not really given their support to the new chain. A lot of like the big builders have kind of left. So I'm personally fairly bearish on it. I'm, not as interested as I was previously.
So now, what does this mean for what at the end of the day we hear, okay, this coin went to zero. What is the actual, like, what does that fucking mean for people who had like $1,000 invested in Anchor Protocol?
To give you an idea, from the top, I think Terra or Luna token was 116 to 120, somewhere in that range, just a few months ago. It's trading at fractions of a penny now. So
116.
Yeah, dollars. Yeah.
Yeah.
To basically nothing now. UST, some people are still trading it. Like, I think it's worth 6 or 7 cents. Or sorry, yeah, 6 or 7 cents. Yeah. So.
Okay. All right. So the inherent risks. Let's talk about that. How the fuck did this happen? Like, how does something that was essentially pegged on the dollar and it was marketed as something that was safe go to zero? I know we just kind of talked about that, but talk about some of the risks of crypto in general and why this is part of the game, so to speak.
Yeah. So again, every single thing that you invest in, especially in crypto, will have their own risks, or what are called like tail risks. The 1 in
a million chance.
Yeah, and this was far greater than that. There's plenty of people that from the beginning were very skeptical of it ever succeeding, and those tail risks did come to fruition. There's been a lot of other attempts at these decentralized stablecoins, and all of them basically have
failed
in that death spiral has occurred. The problem is not having enough backing to it. So Terra was working on creating some type of decentralized backing to the UST stablecoin. So at this time, they had like $4 billion in backing that was basically allow people to sell their UST into Bitcoin instead of the Luna token if people didn't believe in like the Luna token. I don't really want to get into the dynamics of how like UST and Luna worked. It's a little bit much for this conversation, but basically it's just faith in the system. There wasn't enough faith in the system to keep enough buying pressure to buy the UST token back to peg. And once that faith collapsed, then the whole thing just basically went to zero immediately.
It goes back to like, it sounds like the whales, so to speak. And like this happens in NFT projects too, where whales come in and buy everything or whatever, and it makes it impossible for the individual user to actually get a hold of something. So is that just an inherent problem with this? Is there any way that decentralized currencies and crypto like can keep those people out? Do you want to keep them out? Like, how do you feel about that? Because it seems like every big, like, happened pump and dumps on Wall Street happens still. The whales come in, they buy everything, sell everything, and they can move the market. So what are your thoughts on that? Is that the problem?
I don't really think it's the problem per se. Having a lot of money, you need a lot of money in the system to create liquidity so that you have a tighter, more efficient market. When there's very little liquidity in the market, that's when you see these massive spreads, and like retail ends up a lot of times getting more hurt. In the traditional market, it's a very efficient market, so the whales can't manipulate it as much. They can manipulate it a lot more now, but you also need that capital in the system in order to create the efficiency long term. So I don't really say it's inherently bad, but because it's not like fully regulated, I think the manipulation can be a little bit easier, even though everything is transparent and like can be tracked on chain. Maybe in the future, some whale manipulation is they're held accountable for it, just like in the traditional market, but. It's hard to say. I don't really have like an opinion one way or another on that. I don't know this stuff. So like the thought for me would be like, okay, decentralized currency. If it's truly decentralized, why do we need the whale? Like what percentage of Terra and Luna was it like 80-20? Like, say you're 80, like say 10 whales or whatever, 100 whales or whatever, did they have like 80% of this shit? And then the rest was like just your traditional retail buyer like you or I? I think the majority of like the UST ownership and Luna probably was controlled by whales. The chain, Terra was definitely not decentralized in like what crypto native people would consider decentralized. Like really only Bitcoin and Ethereum are like truly decentralized at this point. Right. Everything else is kind of running on these, or they're definitely run on centralized, like, you know, systems where there's not very many validators that are, you know, protecting the network, and they're kind of controlled by these centralized entities that are making the decisions on behalf of what happens as far as the development in the chain. So yeah, Terra definitely wasn't decentralized in really either manner. But the goal usually is to become more decentralized over time. Like Ethereum, when it first launched, and Bitcoin, when it first launched, was not decentralized. They become decentralized as they grow.
Which is like that makes sense. The opposite of the traditional way.
Yeah. And that's a big argument kind of right now, is same thing with like DAOs, these decentralized autonomous organizations, which, you know, very well may be the future of like the LLC. I don't know if we want to talk about that at all, but you're seeing a lot of issues with people trying to decentralize too early, because that's kind of the ethos of crypto, is creating this decentralized network. But when you do that too early, then it's hard to actually maintain governance. And like, if you give it to the community to make decisions too early, a lot of times there's bad incentives to, you know, try to make it more profitable for yourselves, and then, you know,
bad for the organization.
Exactly. Yeah. So you'll end up either having like a whale, or like someone with, you know, buys one coin and then, you know, puts out a bad proposal, or, you know, votes on something when they don't really even understand the system, and it kind of just throws off, you know, the direction of where the project's going. Like one example is like Sushi Swap is a competitor. It's a decentralized exchange. It's a competitor to Uniswap. It was like the first kind of DAO model of these decentralized exchanges that was doing really well for a while, and is basically like fully collapsed because a lot of the founders ended up kind of get kicked out by the community, and then there was no one running the ship, and then it's just kind of collapsed with no leadership. So it's
a balance of chaos and order on these things.
Yeah, exactly.
Kind of crazy.
Yeah. So
wow, that's very interesting. Okay, so for the normal everyday person, you know, you taught me, or told me to grab a ledger, which I got and still haven't even like opened, you know, but which I'm working on. But we're looking at, obviously, like things are down right now in the crypto web 3.0 world side of things. Excuse me for using those like buzz terms. But if you're just like a normal person at home who's working a 9-to-5 job, maybe they're paying rent, whatever, they're just chilling and they have like a couple bucks in their bank account, like what is the appropriate way to like look at investing, or not to give advice, but like what do most people do? If like someone out there is just getting into it, like what do you see as a normal way to invest? What's a safe way to invest? How can people get involved? Is now a bad time to get involved? Like, you know?
Yeah, again, this is all my opinion.
All your opinion, not financial advice.
Do your own research. But you can look at what a lot of like the billionaires are doing. So Kevin O'Leary from Shark Tank, or, you know, Mark Cuban, a lot of them start with 5% of their net worth into crypto as kind of an experiment. You know, they'll start with the big ones, Bitcoin, Ethereum. You're generally going to be relatively safe in those long-term, you know, quote unquote safe. From there, as you get comfortable and you start to do your own research and understand the ecosystem, maybe you start to tail out into some of these other altcoin layer ones, what have you, and, you know, eventually maybe increase that to, you know, 10, 20% as you get comfortable with it. But I would say you probably want to wait a year or two of like really doing that research and being involved in the ecosystem before you learn
about it first.
Yeah, before you go beyond that. Because a lot of people, they do 2 weeks of research, feel like they're an expert, and really they don't know anything. They listen to, you know, a bunch of people on YouTube that are just shilling them garbage, and then they put like their whole net worth into something and lose it all. And then so that's all I'd say is do your research and be conservative at first. Stay within the top, probably a couple of coins.
It's about it for me, like, and tell me if I'm wrong, but I had to be more interested in learning about it in general and just like prepping myself and giving myself armor, because I know in 10 years, this is where the world is going. So like for me, it was, okay, I need to do this just because I want to learn about it. I'm curious about it. Not so much I want to make money. Like if you kind of get into it right off the bat and you're just like, I'm going to get rich quick. It's like, just like anything else, you're probably going to get fucked. Like,
Yeah,
you're going to screw yourself over.
Even if you make money in the short term, you're going to end up losing it. Because then you get overconfident. You know, that's probably the worst thing that you can do is be successful right off the bat.
It becomes gambling if you don't know what you're doing.
Yeah, it's a lot of people just say it's a big casino, which to an extent they're right. And you've seen a lot of like scams pop up over this last year, and that's another security thing is there's a million scams in the space, especially in like the NFT world.
Holy fuck.
Yeah.
Let's talk about that. What are some like, all right, give me like as many as you can name off the top of your head, like number one, like, or top 5 things to look out for. Number 1 for me, because my buddy did it, is if you go on OpenSea for NFTs or whatever, like make sure it's a verified project, because there's like, they can just name it the same thing or make it look similar and just, it's bullshit.
Yeah,
and he did that. And he bought
basically make sure
accident.
it has like a check mark next to it. That's a big one on OpenSea. Honestly, I wouldn't recommend anyone getting to NFTs without like already being, you know, pre-crypto native and understanding it, because you will lose money. That's like the riskiest thing that you can do within crypto is get into NFTs, because they all are illiquid and often go to zero. I mean, even some of like the big projects, like there's one called Azuki recently that was basically considered like a blue chip project by a lot of people in the space. And basically, I don't know, the founders kind of like rugged it. I don't actually know the full details of it, but
rugged it means a rug pull. They just fucking bailed.
Yeah. So I can't really give a lot of advice as far as NFTs specifically either, but just understand that a lot of 99.99% of NFTs specifically are going to go to zero. Yep. So, that's one thing. Going back to getting a ledger is a hardware device. It's a what's called a cold storage wallet that's never connected online, and basically you can self-custody your assets. So that's a big thing about crypto, is that like you can become your own bank. I think we generally talked about this last time. But there's also, you know, inherent risk of holding your own coins, say your Bitcoin, on an exchange, on say a Coinbase or a Kraken or whatever it may be, because that exchange, you know, could go bankrupt. They could, you know, get hacked themselves. They could lose your funds. They could have their assets frozen. In fact, the founder of Kraken a few months ago tweeted, he was like, honestly, people should probably take their funds off the exchange because
put it onto a ledger.
Yeah,
instead, right?
Because they were getting regulatory pressure, and basically they said that they would have to freeze assets if, you know, the government told them that they needed to.
So basically, if I have $5,000 on Coinbase or Uphold or whatever it is, I can take my money off of that and put it onto a ledger, and that is totally decentralized. No one can regulate it. It's just there.
Yep, and technically, if you secure it right, that's like the safest way to hold any crypto or, you know, something that has any monetary value, NFTs included. However, there's probably way more risks involved in doing that than holding your funds on a trusted site like Coinbase. So for most, you know, retail, when you get into it, using Coinbase is probably the safest way to hold your funds. But some risks involved in trying to self-custody is if you send your funds from Coinbase to your ledger hardware device and you punch in the wrong address, you can lose all your funds, and there's no 1-800 number to call in.
Have people done that?
All the time. Yeah. I mean, when I first got into it, I did it once, and granted it was a test transaction. Yeah. Usually when people get into it, they're so scared about it that they'll send like $1 just to make sure it gets there. And I've done that. I mean, almost everyone has.
That like just made my hands sweaty thinking about like, it's like Venmo. When you Venmo the wrong person.
Yeah.
Someone Venmoed, it was like $60. They were like, yeah, I Venmoed you. I was like, no, you fucking.
Yeah, no, it's happened to me too. Someone's Venmoed me money.
That is like.
But yeah, you can do that with $1 billion and
infinite dollar. Yeah. Oh my God. Yeah.
So that's a huge risk.
So fucking test send before you do the actual send on a ledger. Okay.
Yeah. If you're new to it, you know, at this point for me, I don't do that.
I'm new to it because I still have to do that.
Yeah. So when you first set it up, I would definitely recommend that. Also, you control what's called like the private key to these hardware devices, or to really any wallet. If that private key is disclosed to anyone else, they can then access your funds.
It's like 12 or 18 words, right?
Yeah, exactly. So basically most people write that down, put it in a safe, do whatever to try to, you know, safeguard that. If you ever lose that and then you forget like your password to get into the wallet, then you're locked out forever.
How do you recommend people storing that? On a piece of paper, on a Word document, in 12 different places?
Yeah, there's a million different ways that people different lengths that people to go to try to secure them.
But the more places you put it, the more vectors of exposure.
Yeah. So like, let's say it's a 12-word C phrase. Yeah, you could write it on a piece of paper. At that point, there's risk of losing it or it catching on fire or something. So I would get a fireproof bag, put it in a fireproof safe, make sure it's in a safe area. They do have these like steel tablets that you can actually basically engrave it, or get these like little tabs that you can put the C phrase on. That's smart. A little bit more fire resistant. Some people will split it up. Yeah,
but then you're giving your seed phrase, you're engraving it, and someone has your seed phrase, no?
Well, it's just on a little it's on a metal tablet that you put in a safe.
But who engraves it?
You could do it yourself.
Oh, okay.
Or people have like these little like individual tabs that they fill it in.
Oh, I was gonna say, holy shit! If the people are just like on Etsy, like just send us your seed phrase, and like we'll make a little password thing for you.
Would never recommend.
Never give that away to anyone. Okay, I got it.
Some people split it up where like 6 words are in one area, 6 words are at like their parents' house or something, and then you have to combine them. So that's kind of like called a multi-sig, where you have like different people that can help you access your funds.
Yep.
So people go to crazy lengths to protect these things. Like some people have them in like 3 different locations all over the world.
I mean, if you have a shitload of money, I get it.
Yeah. And then you can also split it up by having on different, wallets or whatever it may be.
This is like the Da Vinci, like in 25 years, it's going to be like the Da Vinci Code.
Yeah.
People like, oh, there's like a million Bitcoin sitting in a safe somewhere.
Yeah. So, I mean, there's a lot of inherent risk of trying to self-custody yourself as well. So that's where you can't really make any recommendations to anyone individually, other than like if you're going to use DeFi at all, where you actually are taking your funds off of an exchange and using what are they called, like these hot wallets like MetaMask, where it's just a browser extension wallet that's controlling your private key. If anyone hacks into your computer, like they could steal all those funds. So at that point, if you're going to try to do anything in DeFi, like do on-chain transactions, then I would recommend getting a ledger and testing that out a little bit before.
Got it.
Do anything.
Okay, that makes. And then how does the ledger interact with your MetaMask though?
So the ledger actually creates its own private key and its own wallet address that protects it. So the funds aren't actually sitting on the ledger themselves. They're like sitting on chain through the private key, and it just basically uses MetaMask as the UI, as the user interface to interact with these DeFi protocols. But the ledger is the one that's actually protecting those funds on chain. And then you just manually like approve the transactions on the physical device.
So even if someone steals your computer, if they don't have your ledger, they can't get it.
Right. Yeah.
Very cool. Okay.
Yep. Exactly. So.
Any other safety tips, advice for getting started, that sort of thing? Major ones people mess up.
Yeah. God, there's a million of them. As far as like general security, I would definitely recommend getting like a VPN, malware protection. There's this thing called Bitwarden, which is like a password manager that I recommended you getting. That's front end, back end encrypted. It basically allows you to create these extremely long safe passwords, or every single account that you have has its own unique password.
Yeah.
I would try Proton Mail. It's an encrypted email service as well. That's really good. As far as the general risk in crypto, again, everything has their tail risks. Everything at some point could go to zero. So just understand that.
And if you go back to first principles and don't overextend yourself from the beginning, everything could come to fruition and it could go to zero. But if you invested properly and diversified yourself well, it's not really a catastrophic event for any individual person if they've done the first principles right, which is don't overextend.
Yep, don't overextend, and definitely diversify your assets. So
that's good.
Not just in crypto, but in general.
Yeah. Okay. So we're in the wake of like you said, blood in the streets, right? That's like really where we're at right now with the crypto side of things. How do you stay optimistic about this when something because this was like a big event, right? Like how would you compare this to as big as it gets for like messy stuff?
It's basically as big as it gets. Like it's definitely a huge black eye in the industry. The equivalent is probably like there's an exchange called Mt. Gox that I don't know years ago. Basically, it was like the main Bitcoin exchange went under and a bunch of funds got lost. There's another one called Quadriga, which is actually a Netflix documentary, but it's interesting, where the founder basically rugged and stole all the funds that were on it.
Wow.
There's another one, actually Ethereum originally. The reason why there's Ethereum Classic was because there was basically the first like Ethereum DAO was hacked, and it was holding I think like a third of the Ethereum in circulation in there. That was all hacked and stolen. So like there's definitely been like major black eyes in the industry, but this is definitely like one of the largest ones, especially recently.
Yeah. So how do you stay optimistic? How do you stay like giving a shit about this and not being like, all right,
yeah.
I'm out?
So a lot of people, especially when they first get into it, and definitely when I first got into it too, they're just interested in making money, and like that's fine, great.
Guilty.
I think over time, people start to really appreciate the technology that's being built and really seeing the long-term vision of like how this is going to positively impact everyone's lives. You know, as far as again personally being able to custody your own assets, the censorship resistance that comes along with crypto generally, the sovereignty of it, and then also just like the real world implementations of them in business and creating the efficiencies that, you know, we talked about in the first section of the podcast.
Yeah. So maybe this is a step backwards, but do you still see, like, where do you see things going 10 years from now? Are you still optimistic, you know, in the fact that this is going to be a big part of business, everyday life? Like,
yeah, I think a ton of these businesses that will derive from crypto will, you know, outcompete a lot of the Web2 incumbents that they're, you know, trying to disrupt currently. Yeah. I think a lot of the smart Web2 companies will integrate a lot of the crypto technology on the back end to make them more efficient and then supercharge, you know, their abilities and outcompete, you know, their competitors. So I think either way, you know, crypto is still inevitable when you understand the underlying technology and what's being built. So yeah, for me personally, like you said, in general, when you're investing, you want to buy when there's blood in the streets, whether that's now or 6 months from now, a year from now, who really knows? But generally when the markets are down 50, 60, 70%, that's usually a decent time to buy or at least start laddering in any market. Yeah. So yeah, I mean, long-term, next 2, 5, 10 years, I kind of know where the industry is going. I do believe that the overall crypto market cap is going to be exponentially higher because this is an exponentially growing asset class and exponentially growing technology. So I just look at it from, you know, long-term time horizon. So I'm perfectly comfortable like with where the market is, and I'll just continue to, you know, dollar cost average into the market as we start seeing lower prices. And, you know,
is that the advice that you'd give? Like, well, can't give advice, but to the person who is like thinking about investing or getting into this, and then this happens, or they start worrying about a recession, or what would you what would you give that, like, say to that person?
Yeah. So the tough thing right now is that I do think that we're already in a recession and it could get a lot worse. And crypto's never seen a recession. It was born out of the last recession. And so it's seen multiple massive down cycles where it's dropped 95% while the traditional market was going up and making all-time highs.
Yeah.
So now with
volatility, it was born in volatility.
Yeah. So while the traditional market is dropping significantly, crypto is definitely going down with it, and it's hard to say what that's going to look like a year from now if it just continues to sell off massively, or if at some point crypto starts to decouple from the traditional market and actually, you know, live up to some of those primitives that or the value that some of the crypto, you know, say DeFi, for example, provides, where people can take their cash that they just sold into and put it to work in DeFi and earn some type of yield that they can't do in their bank account or their brokerage account. Yeah. At some point in the market, you might start to see that. That could be another cycle from now. But yeah, I mean, that's kind of what keeps me going, is trying to be early to the newest technologies and knowing that if I stick with it, you'll reap the benefits of the exponentially growing market. So
yeah. Now let's I want to kind of talk about that 10-year horizon, where this goes in the future, and like on an optimistic, like exciting level. Where do you see this? Like, what's a big application? Like, you mentioned something about LLCs, like the future of LLCs. Like, what did you mean by that?
So there are these things called DAOs, decentralized autonomous organizations. It's basically a way for people to organize and kind of run businesses or operations a good example of it was there's this thing called the Constitution DAO. For anyone that hasn't heard about it, I don't know what it was, 6 months ago, there was an auction for the Constitution at Christie's or Sotheby's or something. And there was, I think they thought
I've
it was
heard
gonna,
of this.
Yeah, I think they estimated it was going to go for like $30 or $40 million, when it sold. So there was a couple of people on crypto Twitter that were like, hey, this would be really cool if like we put together a Constitution DAO. Everyone across the world can put their money into this one fund and then try to buy it. And then this Constitution can be like basically globally owned by all the contributors instead of just one billionaire. So
and then we can leverage against it, sell it, do whatever the
yeah exactly yeah. So then we can vote as like a community what to do with it, where to store it.
Oh, burn it. Yeah,
burn it,
psychos.
My god. So basically within like 3 or 4 days they raised whatever it was, $40 million globally just from thousands of contributors. I put money into it just for fun, just to see what happened, and we ended up coming in second place in the bidding to some billionaire. I forget his name. I think he won it for like 42 million.
You were probably like what, 38?
Yeah, something like that. We actually had a little bit more in funds, but they needed like additional in reserves, so we couldn't like bid any higher. But yeah, it was a cool experiment. But it was just like an example of how.
Did you get your money back?
Yeah, so they ended up.
What percent did they take?
No, they actually didn't take any percent. So what they did was they distributed these DAO tokens, these Constitution DAO tokens that then you could like sell on an exchange. And they were actually worth significantly more afterwards, just because the kind of the story behind it.
Cool.
So yeah, I ended up making like, I don't know, 4 or 5x, whatever it was,
wow,
in a short period of time. It wasn't, granted, it wasn't a ton of money, but initially they were toying around with the idea of just like sending back the ETH to all the participants.
Yeah, because that could have gone the other way too. No.
Yeah, it definitely could have. But it was just too costly to send back all the ETH. Yeah. Because transactions on Ethereum are expensive. So they ended up just deciding to do these DAO tokens, which I think most people were probably made whole or made some money on.
Yeah.
But yeah, I mean, it was a cool experiment. And that's just, again, an example of people being able to congregate together and like with a common goal from all over the world, raise funds quickly and, vote on what you do with the funds. So if they had won it, they would have voted on where to store it, maybe put it in a museum where you can raise funds by charging people to see it, create some passive income from it. There's a million different ways that could have gone. But a lot of people think that that's the future of organizations, where they won't have these like LLC structures. They'll just be DAO structures where that you can form them easier. They have no borders, where it's not like a US entity. It's just a global entity, basically, that anyone in the world can kind of join and be a part of something.
And it's much more binding, technically speaking, right? Like you're locked in as opposed to just like on a piece of paper and then there's a government that enforces it. It's like,
yeah,
pretty locked in, no?
I'm not sure about the locking in. I guess maybe. I haven't really thought about that, but there's just a lot more interesting things that you can do. It's much more dynamic and fluid, which is all about what crypto is creating these efficiencies.
We'll say for like and sorry, because I've seen this before, unfortunately, where it's like two people go into a company together, and then I know a guy who just fucking took off. And it's like they tried enforcing it, but it's like, no, he took his bank account, he took his money, and he screwed, and he left the other guy holding the bag.
That's part of what the end goal is that these are truly like autonomous organizations. Right now, again, they're more centralized, but eventually the goal is to have all the funds, say for whatever this company is, in this DAO structure that nobody has individual access to, or they can't just steal the funds. The community would have to vote on what, how they allocate the funds. There'd be like a multi-sig wallet that controls like when you take funds out or how it gets distributed.
Wouldn't that could change the game of like fundraising and
fundraising, absolutely,
because there's so many friggin' crooks in charity, and that's awesome.
Again, everything's open source, so like you can see all the funds that are in this account. Everyone has access to it. So there's just a lot of interesting things. Like there's another fun example of this. It's called the Kraus DAO. It was just a couple of basketball fans that were like, hey, wouldn't it be really cool if we put a DAO together that bought an NBA team? And
the Kraus DAO.
They're actually making like real traction on this, and probably eventually they will buy an NBA team.
Yeah.
And it's going to be just a bunch of community members that put funds together, and they're going to probably go by an NBA team.
That's already pretty much what people do. You have to put together a team anyways. You know what I
Yeah,
mean? People
and
think like Magic Johnson owns the Dodgers. It's like, no, he owns like a small percent. I think it's like 5 or 2% of the Dodgers.
Yeah, and the thing is like how things are now with investor accreditation laws is that really only people with $1 million net worth can get access to investing in things like that or private companies.
And you need goodwill, which
so this just like kind of enables anyone in the world to get access to a lot of these things. Now, granted, there's going to be regulation that comes in as well. I think a lot of that will figure itself out over time, but it's still like super early stages. It's all experimental currently. So,
cool. That's awesome.
Yeah.
All right. Well, dude, I think that's pretty much everything I wanted to talk about. Anything else you want to kind of go over?
No, I mean, I guess that's it for now.
Crazy couple fucking weeks. What's next? So what's next for you? What's next for the fund? What are we doing next?
Yeah. We're still just chugging along with the fund. I'm kind of working on a stealth project currently that we have some initial interest in.
Awesome.
So I talked a little bit
offline.
Air.
Yeah.
So I mean, eventually when that's
up and running, will you come back and tell us about it?
Yeah, absolutely.
Okay.
So.
That's awesome, man. And tell people how to find you, where they can get in touch with you.
Yep. Twitter is the best place. It's at Nick Hayes 11. That's where basically I live now.
Perfect. Okay. Nick Hayes 11. And then if people have any questions about crypto, if you're looking to just talk about it, learn how to invest in it, is it okay for people to reach out to you, hit you up on Twitter?
Yep.
All right. Reach out to my man. And as always, Taylor Cacciola, the Namra podcast. Thanks guys. And we'll talk to you soon.
Yeah,
thank you, Nick. I appreciate it.
Yep.